Hi, everyone. Thanks for joining us today for the final closing panel of Inclusive Fintech 50. I'm Amee Parbhoo, Director of Investments for Accion Venture Lab. We're a global early stage fund focused on fintech for the underserved. Today's roundtable is on a dauntingly large topic, the future of inclusive fintech. But we've got a fantastic group of investors to tell us exactly what that future holds. I'm excited to hear their insights. So there's a lot to cover, and we're going to go ahead and get started. But just a reminder to please share your questions in the chat, and we'll make sure to save time at the end for Q&A. Let's start with a quick round of introductions. Who you are, what you do, sort of where in your fund fintech fits, if you're focused exclusively on fintech, if that fits in kind of a broader thesis, and also where in the world you're zooming from today. Go ahead and get started. Tarek, if you don't mind kicking us off.
Sure, thank you, Amee. My name is Tarek Assaad. I am one of the managing partners at Algebra Ventures. We're a Series A venture fund that's focused on Egypt geographically and the region around Egypt. So we invest in the Middle East countries. We're not a fintech fund because of our geographical focus. We do have fintech investments, and fintech is an important part of our portfolio. And I'm zooming from Cairo, Egypt.
Arjuna, can you take us next?
Yep. This is Arjuna Costa zooming in from California, where I'm watching the sun rise early morning. I'm one of the managing partners of Flourish Ventures, a global fund with our overall mission focused on helping people improve their financial health and economic resilience, be they consumers, small business owners, or self-employed. So almost exclusively focused on fintech, but even deeper on this idea of financial health. And we invest across the US, Latin America, Asia, and Africa. And like Tarek, early stage seed, Series A, Series B investing. Thanks.
Great. Maelis?
Hi, everyone. I'm Maelis Carraro. I'm the managing director of the Catalyst Fund, and I'm zooming in from Boston, although I'm usually based in France. The Catalyst Fund is an early stage global tech accelerator and philanthropic fund that focuses on supporting really early stage inclusive fintech ventures with a combination of grants as well as very hands-on and bespoke venture building support across the portfolio. And so our thesis is also to support ventures that are building what we call affordable, appropriate, and accessible financial services that can improve the financial health of underserved population and small businesses.
And my name is Melissa Bradley. I'm joining you from Washington, D.C. I wish I was in some of these other places. I wear a few hats. I'm co-founder of Eureka, which is a platform for small businesses, and we provide mostly non-dilutive funding that is sector agnostic all across the U.S. I'm also general partner of 1863 Venture Fund. We invest specifically in Black and Brown founders in the context of the United States, again, sector agnostic. We wish we had more fintech companies, but we have a few. And then I serve as a venture partner at Next Gen Venture Partners, which is also based in DC, and advise a couple other funds. So I spent a lot of time looking at investments across the board, but mostly particularly by Black and Brown founders. I will say that as a finance person and someone who spent time working for Treasury, I am always looking out for companies that are focused on this issue of inclusivity, particularly as in the US context, post-George Floyd, there's been a lot of talk around inclusive economy. The Pope came out. I have to say that as a Jesuit student at Georgetown University. And so we're really excited that this concept has now gone global, and people are finally paying attention to this opportunity and recognizing financial services and fintech are really at the core of creating some of this democratization to access.
That's great. Thank you all. And no reason to knock DC, not a bad place to be zooming in from.
It's just cold. It's like 40 degrees compared to what Arjuna is going to experience, yes.
Great. Well, thank you all for those introductions. Before we get into the future, I'd like to spend a little bit of time reflecting on this past year. The impact of COVID can't be understated, particularly for the underserved customers that you all talked about, hoping to reach, and for the companies that are building solutions for them. So, Arjuna, maybe you can start us off. From what you've seen and what Flourish has seen, how has COVID impacted the flow of capital into the inclusive fintech space? Have you seen more or less energy for our work, shifts in the stage or types of models being invested in?
Sure. Uh, Thanks. Let me start off by actually starting at the customer end, right? It's clear that this global pandemic, which started out as a health crisis, very quickly rippled into a deep economic crisis. And as these crises tend to do, disproportionately borne by the poor, informal workers, gig workers, right? Everybody who already was financially vulnerable, this just magnified the impact on their financial lives. And what we've seen is both drastic um, sort of negative impacts as well as great resilience from this population, which is what we've come to expect over time, right? These are people who are living paycheck to paycheck, living on the edge, scratching for a living, hustling on a daily basis, and they've really figured out a way to to sort of create a soft landing for themselves where possible. Governments have stepped in to create some of that cushion, and it's also created an opportunity for more creativity from entrepreneurs to try and solve solutions, which is what we see when these crises tend to hit. So to your question, what has happened to the funding landscape? I think I can probably generalize that every funder across the globe spent the first 2 or 3 months deep in triage mode, right? Thinking about their own portfolio companies first. How are they going to survive? What's their cash positions? Does it look like they have enough to last the next 12, 18 months? Because there was so much uncertainty at that time. We just didn't have a sense of what was going to happen. And then as things started to settle down, people started to look outward. Now, it was very different to think about investing in a world where you couldn't touch and feel the company, the problem, travel beyond the ground. But what happened as we saw it was money started to flow a little bit, not rapidly, not as much as we would like, but certainly not as negative an impact as what we initially thought would happen in the early days of the pandemic. And particularly around digitization, right? What the pandemic did and the lockdowns did was really create tailwinds for digitization, particularly around digitization of money. So I think fintech probably benefited from that trend, both from a performance perspective and therefore from a flow of funds perspective, because people saw this trend shift and started to get behind it. I wonder if that's the experience of some of the other funders around the table as well.
Yeah, I would say, again, here, thinking broadly, but starting here in the States, I think the respectfully, I'll say the debacle of getting aid to small businesses once again showed the challenges with our pipes, with the distribution channels that we have to get money to folks, particularly the unbanked or underbanked, right? When the PPP program was released, it just demonstrated that I don't really care how old you are, what race you are, what gender, ethnicity. If you had not had a long-standing relationship with the bank, you were pretty much SOL. And it became really hard and obviously an afterthought to think about community development financial institutions and afterthought to think about how do we leverage fintech platforms. And I think it just goes to speak to a disconnect between the policy side, some of the investor side, and the consumer side. Consumers are agnostic. They just know when they need money, they need money. And we've seen amazing examples where your cell phone is your bank when you go to the continent. Having spent some time in Ghana and Morocco, I'm like, we are so far behind in the States, dare I say. And so I think there are many of us in the States who are currently not investing internationally, but looking of how do we make international connections to be able to bring that level of technology and advancement around thinking and business models to the US, and certainly trying to move the needle, both in terms of more companies starting, but also more business models. I think as someone who spent time as a regulator in Treasury, I'm thrilled at the plethora of opportunities that we have. I'm still a little worried, though, that we have not been able to manage some of the cost structures of these entities that thereby have predatory rates that are oftentimes passed on to the end user. But I think, when you're a small business, in particular, and trying to get money a couple points here and there are not going to matter, but I think longitudinally, if this is to move beyond certain segments of those who have emergency needs or urgent needs to be more of a consistent way of banking and accessing cash, we will indeed have to work on some of the pricing and cost structures.
Maybe I can offer a perspective from Egypt, and I think many of the countries structurally similar to Egypt. I think one thing the pandemic has done is it's really accelerated the adoption rates. So, some of the issues we're dealing with is that people are unaware of what digital solutions can do for them, and I'm talking about consumers mostly. But with COVID, people have been pushed into doing more. There's a lot. People are talking about it on the media and at the cafe. If you still go to an outdoor cafe next door, it's just become a much more integral part of life, and not just financial inclusion, but I think across services. My partner actually calls this service inclusion. So it's not just the ability to access financing, but also the ability to ride hail or have access to basic services and goods at a decent price, cutting out the middleman. There's a lot of these types of efficiency plays that we have seen since COVID that have accelerated significantly. I think because partly entrepreneurs are thinking of ways to solve these problems and are coming up with interesting ideas that are adaptable to the local environment. But a big part of it is the higher reception, higher adoption rates, and higher level of comfort with digital solutions from the consumers at the bottom of the pyramid.
Yeah, I agree as well. And to Arjuna's point, we've actually, as soon as the pandemic hit, we've tried to do a lot of user research to really understand how the consumers of the fintech companies were being affected, and saw that 80% of the incomes, basically disappeared. They only had 3 to 4 weeks of savings left to cope. Many of them, the ones that actually already had liquidity issues, could not access credit when they needed the most, because obviously their ratings were not good enough for formal financial institutions, and many of them were not insured. And yet, in spite of this, we saw that the fintech companies, especially those that we work with, were able to quickly pivot or try to really support their customers and go above and beyond, when in fact they themselves needed to be in cash conservation mode and obviously cost cutting mode for many of them. So that has been very inspiring to see. And I think that many of them have, therefore, after now, so 7 months later, 8 months later, who's counting now, has seen growth actually in transactions and general growth even in funding for some of them. But it is, I think, because of the value that they provided to those customers right there and then when the pandemic hit. And to your point on fundraising, I think that in the initial months, certainly a dip. But now, hopefully, we're on track to actually see a lot more deals close and investors regaining confidence. So I'm actually quite optimistic with the outlook of funding, and I see creativity there too from the entrepreneurs looking at diversifying the sources of capital when they think about working capital, concessionary capital, first loss capital, grants, or debt versus equity. I think there's a lot more creativity.
That's great. And I want to come back to that point of looking into 2021, right? What creative solutions are we seeing and how are folks feeling about the funding landscape? But before we do that, I did want to kind of hit on a point, Arjuna, you touched on, which is this major shift that all funds, including us, have had to do adapting to a remote world. Like you said, no more flying for a board meeting or, going to see portfolio company or, doing diligence on the ground. So I'd really love to hear how your funds have all adapted to this new world. Maelis, maybe starting with you. I mean, as you mentioned, Catalyst Fund, you guys are known for your very hands-on approach. How have you shifted your portfolio support approach?
Well, it's been really hard at the beginning, mostly, a sense of loss, because that's really what we thought we were doing best, was like going deep on the ground, traveling to see the founders and working alongside them as extension of their teams to really make sure the product gets the product market fit. And of course, doing that remotely was a radical shift from our usual way of operating. That said, we had started to do a mix of online and offline sessions with entrepreneurs even before. And we've seen that in many ways, some entrepreneurs preferred to have the ability to perhaps meet more often virtually rather than having, say, 2-3 days of time where you're doing like something very hands-on or a workshop with them, because obviously that's the whole day. And here they can manage the workflow alongside us better, like as a team, and plan it better, even if it obviously required a lot of Zoom time, which then led to Zoom fatigue. I think we're all at this stage now. So that was, I think, an interesting realization that going forward, one of the things that probably will remain is knowing when you can do something online and it's appropriate, when it requires actually to go on the ground. And the area, I think, where that is for us has been most difficult is the user research. So what we've done is actually trying to really deepen our relationships with local partners, whether it's research partners or investors on the ground or other corporates that could help the entrepreneurs, because we cannot go there, and work with them to, for example, give us the insights needed to improve the product and service. So those relationships have been key. And I think I'd love to hear of other investors, but I think a similar trend might have been happening on the due diligence front, like relying more on partners on the ground and just collaborations.
Yeah, Arjuna, I'd love to hear your thoughts on this, especially on the due diligence side. How have you, assuming you're making new investments, how have you done this diligence remotely?
Yeah, sure. So maybe I'll cover a range of things of how we've adapted to this new reality, at least, and let's hope a temporary reality. Amee, first, in terms of portfolio support, right? As Maelis said, we've been used to spending 2-3 days with companies, developing deep, intense relationships. Hard to do from a distance, but also the portfolio companies, this is new for them, for a lot of them to go through this down cycles. 2010 and that prior recession was way back in the rearview mirror. So what we tried to do was to actually bring the community together across our portfolio. First, we picked certain themes, so created subgroups of CEOs and teams and allowed them to network. And we found that peer learning was probably one of the most powerful ways to keep people working through the crisis. Things we would have done in person, we had to revert to Zoom, but found that it was a different way to bring the portfolio together across time zones across the globe, working on similar problems, who shared a similar value proposition. The second thing was, how do we stay close to the market? And like Maelis said, we doubled down on research. We did a multi-country study we called the Digital Hustle, to see how financial lives of gig workers across both developed and developing markets were impacted. Normally, this would have been done by, and this investor group does this really well, wandering around markets, talking to customers, talking to potential customers, talking with CEOs to really get a pulse of what's going on the ground. Without that ability, we had to resort to sort of a third-party view of what was going on. What it did do, however, was give us a much broader sense of the problem, right? We could survey 100, 200, 500 people to get views, and then start to really narrow down on where the challenges were and where we could intervene. The third element, I'd say, is how we function as boards. Particularly in the emerging markets, these board meetings tend to be 2-3 days, because for me to fly from here to South Africa, that's 2 days. So I spend a lot of time intensively with boards. In the absence of being able to do that, how do you think about engagement with fellow board members and the company? Interesting to note, we just did this sort of the end of the year. We've had a couple of board effectiveness review conversations inside the board to see how we did over this year. And I'd say from a practical adding value fiduciary responsibility perspective, this more frequent digital communication has worked very well. I'd say where the reviews started to show a little bit of fraying is in the board's passion, enthusiasm, connection to the vision. And a lot of that was coming from being together and being with the customers, because it's so important to sort of represent that customer voice at the board meeting. And that really is what gives the nuance to the decision making. So it'll be interesting to monitor that. Now, looking forward, how did we think about new businesses? and new investments. We have made a bunch of new investments starting, I'd say, in June. So 3 months after the real depth of the crisis. The first few investments were all in companies that we'd known and were in the pipeline. So we had that connection that had been developed over time. But we have also made investments in companies that we've only met on Zoom. Kind of funny, we've done customer visits on FaceTime where the CEO is walking around talking to customers with a screen in front of him, and we're on the other end on FaceTime or Zoom or WhatsApp or whatever the mode might be. Doesn't give you a real tangible sense of the reality on the ground, but we're adjusting to this new reality. And I think to ground us in the consumer challenge, right? This is really exposed vulnerabilities in the populations we care so much about. So it's a time for us to be thinking and leaning into risk a little bit more. And this is where I think the final point, relationships with local investors have always mattered to us. We find ourselves looking for syndicates where there's a strong local lead. Tarek, I think probably Egypt was my last visit before I went into lockdown in February, and we might have had the last in-person meeting I've had in the last 10 months. So these relationships really matter because they have the eyes and ears on the ground. As a global specialist investor in financial health and economic resilience, what we can bring is best practices from what we're seeing around the world. What Tarek brings, which is invaluable, is that local context and that local depth. So working together, I think we can put together syndicates that really work for the entrepreneurs.
That's great. Thanks, Arjuna. And yeah, Tarek, I think people must be knocking down your door right now because same thing. I think, our fund is looking for local, trusted, well-respected funds that we want to form syndicates with. How, from your perspective, as the boots on the ground, as that local investor, how has this shifted how you work with investors? What are you seeing on the other side of the spectrum?
A few interesting dynamics. I think, as sort of the local guys in the context of the geographies that we operate in, we've tried to do a lot of the things that I think Maelis and Arjuna have talked about. So we've also tried to bring people in the portfolio to talk about things that it was a good bonding time, particularly the things that are outside of the norm of typically what a startup thinks about, like downsizing. So we've had a lot of conversations where founders are really scratching their heads, trying to think of, if I need to cut 30% of cost, do I let go of 30% of the workforce? Do I cut 30% from everybody's salary? Do I do a sliding scale? Do we as founders stop taking any kind of compensation? These are not your typical, these at least in our portfolio, were not the things that people spent a lot of time thinking about initially. So, but I think getting to these issues became a good bonding experience and allowed people to share.
Oh, might have lost Tarek for a little bit.
He's frozen for me as well. I mean, probably for all of us.
Yeah. Okay, well, hopefully we'll get him back and can come back to him. But Melissa, might turn to you for a similar question, and also just your thoughts on, is this going to be the new normal, the way we work in a remote world? What Maelis and Arjuna have shared. Do you envision, the way in which investors interact with entrepreneurs will shift in the long run?
Yeah, I'm sure that I'll try to go back. I mean, from our perspective, we've actually enjoyed the decrease in spend of trying to travel around and meet everybody. It's certainly helped have a positive impact on our fund economics. I will say that. I would say we have been looking at 3 different things here in the United States. 3 seems to be the magic number. I think 1, because we invest in Black and Brown founders and post George Floyd, we have been inundated. I think I've literally had over 200 calls in the past 4 weeks, just trying to understand the plight and path of Black founders. And that's been great because it's actually opened up new institutional relationships for us that have actually allowed us to do some significant follow-on investments and mitigate our risk much earlier than we would have ever expected. So I think we are riding this wave. I don't know that there'll be a racial consciousness in the United States forever, but at least, you know, if we're lucky, maybe through the summer, it looks like it'll make it past Christmas. And so that has been helpful. In that, though, we have found that we have also been a go-to source for data. And so I think we heard this theme of like, where do you get the data? I think for us, because there's not a lot of research on Black and brown founders, a lot of it has been anecdotal. And so we have been able to help change the narrative of some other funds and inform, which has been helpful. You know, a very small thing is that we actually mitigate risk from our investment perspective because they have to come through an accelerated program. We have actually dramatically reduced that, but we think it's important that this program now that we're not just doing on a cohort basis, but also one-to-one helps us understand where they were and how do they pivot and navigate toward COVID. So actually investing in something that is ready as opposed to having to wait for them to figure it out. So that's actually helped us accelerate our own process. But what we found is that, you know, as we try to change other people's minds, the national average right now in the United States is that 41% of Black firms have closed since COVID. For us, only 7.5% of our firms have closed. So we are trying to have a counter narrative that there are types of businesses, and some of those have actually been financial services, fintech companies that are surviving, right? And we actually know that over 50% have actually raised money and over 50% have actually increased their staff. And so a lot of that is because through the program, they'd already pivoted, they have online platforms. So I think we've spent a lot of time just also trying to change the narrative. So we've had new partners trying to change the narrative so that not everybody's going under. And then I would say becoming more flexible. We have always been this having multiple tools. So we are really moving forward and being aggressive on revenue-based financing because many of our folks who have already raised capital just don't want to be diluted, right? We are in this for wealth creation for ourselves, but also our entrepreneurs and their communities. And so we want to make sure that particularly the Black founders don't end upside down on their cap table prematurely as there's a need to bring in money during this kind of growth phase to subsidize. So we have been also now deploying other vehicles. And so that's been something that we've seen and people have been really receptive to that. And even other venture investors, because it obviously means we have a senior position. They said, look, you're willing to ride the risk with us. We're okay with this right now. And we obviously are getting paid out within 3 to 5 years. So we're off well before we're going to begin to see some exits. So I would say, you know, this idea of changing the narrative because our folks are surviving, being able to now be in relation with new funds who have no clue or have never worked with Black and brown founders. So it's been a good partnering experience and educational experience. And then this idea of recognizing we've got to go into our toolkit and think differently around how do we help these entrepreneurs during this time. And, you know, we'll hope and pray that it goes well. I think we have early signs that it will as our entrepreneurs are increasing. But I think this is also a place where depending on the types of sectors, we're beginning to see that equity is not necessarily the end all be all at this point in time as we think about the next 18 to 24 months.
That's great. Tarek, I know we lost you for a little bit. Want to give you the opportunity to continue to share on your.
I was saying no matter what you do on Zoom and then Zoom disappears. It's a good example of the challenges that you face in a developing country. But I think the point I was trying to make is that at the end of the day, during these very stressful times, entrepreneurs need someone to talk to. You know, I still have, and throughout the pandemic, was having face-to-face meetings with founders in an open air area and outdoor social distancing and all of that stuff. But I think, you know, being there and having the personal connection and continuing to play that role is very important. We can talk about, you know, how to make your supply chain more efficient over Zoom, that's fine. But when it comes to the insecurities of the founders or, you know, issues between founders, amongst founders or between founders and shareholders or, you know, these types of things, sometimes you still need that connection. I think being able to work with the international investors that we have, our co-investors, to think through what the issues are and then to go out and have this type of interaction locally is important. When we think of existing portfolio companies, but also when we think of pipeline companies and still, you know, trying. We actually just did our first investment where we haven't met the founders physically, and we did it through Zoom. So still, you know, sometimes we'll have to do that, but we still do have a preference for, kicking the tires and getting a sense for what's happening on the ground. But I think, as Arjuna mentioned, we're getting a lot more interest from different types of investors, be they investors who are interested in, let's say, specialists in fintech or in marketplaces or something else, or just people who are interested in Egypt but are in a geography that is, so out of Dubai or out of Nigeria, or we're seeing a lot more interest. And I think, in my mind, venture has always been a very local business, but maybe increasingly so during these more challenging times.
Yeah. Yeah. And I think, Tarek and Melissa, to both of your points, this crisis is showing, I think, a lot more collaboration with different investors, and we are seeing that every day, and that is quite exciting to see, whether it's local, other focused funds coming into the fold, and us thinking about how we can all work together. So quite exciting there. So I guess now, looking to 2021, I'd love to hear from each of you, when you think about inclusive fintech in this space, what investment themes are your funds excited to explore going forward? What are you particularly focused on next year? Maybe Maelis, I'll start with you.
Sure, I get dibs on the first trend. Wonderful. So for us, what we have been observing this year, and I think it's a trend that will continue next year, is the fact that we're entering a new phase, really, of fintech for financial inclusion. And I think we're no longer thinking about it as a set of product verticals that solve specific challenges for the end customer, but rather actually as almost an horizontal platform that can be embedded across several other sectors, other business models that are actually non-financial services first. And so we think about it, the term typically used is embedded finance. And so we try to think about, what does inclusive embedded fintech look like? And in our portfolio, for example, we've had companies like Soko Watch in Kenya, which is also a Quota portfolio company, that were not financial services first. They were actually solving logistics and distribution for small retailers, right, in Kenya. And yet adding the financial service like credit to purchase those products was essential to deepen and strengthen the value proposition for those small retailers, and then obviously open up opportunity to offer a lot more, and also new revenue streams. And we keep seeing this with other models, not just in the marketplace setup, but really when you're thinking about financial services that can help in the health sector, education sector, or digital commerce, or others. And that's really exciting for us, because it really means that we're rethinking the way that we design products in order to meet use cases that perhaps were not as obvious, and then your distribution models to really reach the end customer. So ourselves as Catalyst Fund, we've actually gone through a little bit of a process of rethinking what we've learned and where our method can be most helpful. And we think that this trend will help us go in other sector where fintech can be a force for good and in value add service to other products in other product verticals. So that's certainly one trend. And although I will say that as we see that happening, and in fact, our next cohort, I can't reveal the names yet, but our next cohort will have at least 5 companies out of the 6 that are selected that have this sort of service. Is savings as a service embedded into a platform model, credit as a service embedded into other tech platforms, insurance as a service even, which it's something fairly new, like thinking about insurance APIs. And so as we see that happening, and really everybody is sort of thinking about those new business models, how do we make sure that we continue to have products that are affordable and accessible for the low-income customer? Because once you remove the control over the relationship, because you're suddenly integrated into another platform, how do you make sure you're meeting the needs of that end consumer? You make sure that your pricing remains responsible, and especially if you're working with a lot of financial institutions on the other side as sort of the middlemen. So those are all things that we're thinking about to make sure that all that pricing is transparent and the product is designed appropriately, and yet that we do leverage this momentum, like this moment where we can distribute financial services in innovative ways and ensure their usage, which has been the issue in the microfinance sector, right, for the past decade and more. So yeah, I would say that these are what's exciting for us. We're seeing a lot of salary advance models also emerge. I think that Accion Venture Lab has as well. And we're trying again to look at it with this lens of opportunity, but also how do we keep it inclusive?
That's great. Thanks, Maelis. Arjuna, could you share more about Flourish and how you're thinking about this?
Sure. I think to Maelis's point, this idea of embedded finance, we're really going to see a lot more momentum and activity. And a couple of other things, maybe I'll pick up where Maelis left off around salary advance, which I think of more as sort of using the employer channel to the extent there is formal employment as a way to reach populations that we'd like to serve, right? And we're starting with this idea of salary advances, which to me is a short-term cash flow smoothing product. But can you use that relationship, that channel, that tie into money flows to think more broadly about financial health of your employees? We know that financially stressed employees are lower, have lower levels of productivity. So can we get employers to start thinking differently about bringing and bundling financial services, potentially sort of shifting who pays for some of the financial services back onto the employer? So I'd love to see us make more progress to broaden the sort of aperture from just salary advance to more holistic financial health products. I think, Melissa, you started to touch on this, which was the pandemic and then the need to get money in people's pockets quickly really shone a light on the antiquated banking infrastructure in many markets, right? You contrast India with its Aadhaar UPI ability to press a button and get money to people immediately, with the US that was still sending out checks. So I think we'll see a lot of investment both in rethinking the basic banking infrastructure and then this whole API layer that allows fintechs and non-fintech players to more easily integrate, develop products, and go to market with value propositions that really matter to customers. That layer in the technology stack will see a lot more activity. I also think we'll see central bank digital currency come to the forefront in 2021. Again, the pandemic and the need for quick response has probably accelerated that trend, along with other things like the People's Bank of China starting to experiment with central bank digital currency. So I think these are some of the things, and I know, Melissa, you probably have a unique US view on this around connecting, financial vulnerability, financial health, and tech trends.
I'll pick up there. I think in the U.S. context, low income is a very broad swath of people, and so I think that has been an inherent challenge of most of the financial services from a product development perspective, because there's really no one product that fits everybody. And I would agree the embedded piece is extremely important. We're seeing a lot of our companies recognize that in that shortfall of transparency in the markets here, that they're saying, look, I have customer data, I have a way to accept payment. How do I now then take that to the next level? And so I would say many of our non-fintech companies are now entering this space, trying to understand, so they just reduce the friction of their own company growth, but also the friction of creating wealth in the communities that they wish to serve. I think the other piece that we're seeing here is the connectivity, right? That there is a recognition that banks can only do so much based on their business model. CDFIs can only do so much. How do we connect the dots and actually have this seamless experience of an entrepreneur or just an individual? I think the unsteady path of the ups and downs and the lows do not lend itself to a pathway for asset development. Forget about wealth creation. And so I do begin to see a lot more companies intentionally coming together and saying, okay, if you've got this product in this market, then let's talk about what's the next step and the next step, instead of just jumping all the way to downstream, which most people don't get to. And I'm seeing that amongst the investor community to say, look, how do I go? I belong to 2 angel groups. How do we smooth out that process? How do we create a signal effect to the next round of investors that this company is solid? How do we step up our own efforts around portfolio management and re-engineer and even put more money in? And then how do we make that pathway so that the entrepreneur experiences it? And then how does that reflect on a retail perspective in terms of how people move? And so a lot of, I'd say, unlikely partnerships are beginning to happen toward between non-finance companies and quasi-finance companies. Say, how do we create a mutually useful product for the market? The other thing I will say quickly is that, particularly in the US, I think there is some excitement as January 20th approaches and we have a new presidential administration, assuming all goes well with the transition. There is a significant amount of policy and money that is embedded in that is designed to really adjust some of these ebbs and flows that we see in the markets. And so if that is able to manifest, I am optimistic, but with caution as someone who served in 2 presidential administrations. But if any of that actually hits the market, even if 20% that hits the market, that's a game changer for those here in the States, because the dollars are designed also to smooth out that process in terms of where is there training for entrepreneurs, how do we re-engineer the Fed and Treasury to be able to deploy money to more diverse sources, and then even one that I'm a huge fan of is how do we even think about some of the systemic barriers like alternative credit scores, so that accessibility is not just these one-off products, but we actually are not creating. One of the things I've been hypersensitive of when I started my first financial services company is I don't want to be in the business of creating another lane for people to go down because the primary highway is broken. I want to figure out how do we get people back on the primary highway and fix it. And so I'm optimistic that if some of those government monies are there to come in to reduce cost, to make it more attractive for investors, to create some subsidy, to be some risk capital and create a stack that others can come on top of, that some of these pervasive problems become a little less bumpy. And if we're lucky, 10, 20 years from now, we'll have a better smoothing for that end user experience.
That's great. Thanks, Melissa. Tarek, anything on your end to add in terms of investment?
Yes, I think, in sort of in my world, it's more basic in the sense that there's a lot of laying of infrastructure that is still happening. So there is, it was interesting to listen to Melissa, there is no highway here. So it's, people are trying to still building the highways. I think the ones that do build something, we're excited because we have the first unicorn, Fowry, is the first unicorn in Egypt. So we're all very excited about that. And these guys built infrastructure. I think other companies are trying to build digital infrastructure, and sometimes a mix between digital and physical infrastructure, but really the rails, we have less than 5% credit card penetration. So it's still quite a long way to go. I really completely agree with embedded finance. We have a portfolio of 18 companies, 6 of which we have 2 straight fintech companies. Of the remaining 16, there are 6 that have an embedded finance angle, and these are some of the ones that are really growing and seeing a lot of investor appetite and so on. So even when we think about laying the infrastructure, it's not necessarily going around and placing, I don't know, POS machines everywhere or something like that. It's more of people who have built digital infrastructure who capture certain types of transactions and are in a good position to assess and provide funding for both sides of the transaction. So there's a lot of that going on. I think we'll continue to see these trends. And to a certain extent, many areas are a land grab. So in the context of Egypt, for example, when we think of agriculture, there's a lot that has happened in logistics in the past a couple of years. Something like agriculture, which is in Egypt a very big part of the economy, is almost untouched. So just tremendous opportunities for these types of things. And there's quite a bit of capital, and we're very excited to see the type of talent that we did not see 2 or 3 years ago getting attracted to these types of opportunities. And we think there's a good alignment of the stars sort of for things to move forward. So very positive about next year. I think it's also the pandemic. A place like Egypt is already very challenging operationally, so you have to be very good at navigating and dodging things that come at you from all directions. So COVID was not so hard because of all the other random things you have to deal with anyway. But I think the resilience that the companies that made it through are in much better shape today to really go and address these big opportunities. So generally very positive.
Yeah. Can I add one thing, Amee, quickly to that? Tarek, I completely agree. I think it's important to also recognize that not all markets are at the same, obviously, level of development, that there's some solutions that are still needed that might feel more basic. And so for investors not to lose interest because you're following more of the sexy trend, but building things that meet where the market is at and where the users are at. And also recognizing that while embedded finance is obviously a key trend and exciting, there's also, it has more opportunities for MSCs and gig workers. I know, Arjuna, you've done a lot of work actually researching those needs and how cash flow changes there, but there's also a lot of other populations that are not going to be served now through that model, maybe in the future. So when we talk about, for example, displaced people or a lot of women that are still not comfortable with digital tools. So I think we also have to be realistic about that and make sure that the solutions that we invest in do cover the full gamut, and we don't just like narrow too much. So just adding that as a word of caution also for all of us in the sector.
Absolutely. A really good and important point, Maelis. Thanks for that. I know that we're getting a bunch of questions in from folks. One last thing on my end before I pick out some of the questions we're getting from the audience. Tarek, to your point, I mean, one of the most exciting things is the talent that's involved here and is getting more involved in building businesses. So I'd love to hear from each of you advice you'd give to an entrepreneur building an inclusive fintech business today and going out to raise money, going out to raise capital from your funds in 2021. What advice would you give them navigating this new reality with what's going on in fintech and embedded finance, what's going on with how we're operating and raising money in the environment today?
We have a pretty simple one, so I'll keep it short. Know that what you're doing has not been tried before. So go find who tried it before and go talk to them. And we actually advise that even before they talk to customers. I would say there's been a lot of ebbs and flow of innovation from a US perspective, and a lot of it has not worked. And so we said, before you even start creating stuff and get customers excited, learn from those where it has failed. And that's actually been something most people do, but later in the process. And we're saying start now because the barriers are harder. The systems are definitely broken. That was clear. And I would say there's more money, but not as much money as I would like in the US from a fintech perspective. So you really want to make sure that you're efficient in that process.
I'm happy to go next. The advice we're giving to entrepreneurs a lot for fintech particularly is a lot around regulation. Regulation in Egypt is in flux. We're fortunate that we're seeing people who are very talented, who have done a lot of working with large organizations or with governments and can go and sort of influence opinions and think about the right amount of risk to take and so on. But I think in many cases, some of the entrepreneurs' approach was, I want to disappear completely from the radar screen and I want the regulator to not even know that I exist until I build up some momentum. And I think that has not been a good strategy. With the level of talent that we're seeing, I think regulators want to hear what's going on in the market. They have their own objectives and they want things to happen and they want financial inclusion just as much as everybody else. They might not be big risk takers, they are a regulator. But I think engaging regulators early on, especially if you can sort of talk intelligently about what you're doing and why you're doing it and how it's worked in other markets and how it's created tremendous benefits in other markets, you can actually get these guys really excited. So that's one thing that seems to have worked well for sort of more successful entrepreneurs.
Yeah, and I would complement also what Melissa said. Our main advice to entrepreneurs, because we work so early stage like with them, is to continue to always listen to your customers and also focus on data. Like there's so many ways right now to access data points to make you understand your progress and how well you're doing and integrating your customer feedback. And it's important to go away, sort of vanity metrics, especially at the beginning, and really like ask the core question, which is this delivering value? Am I retaining my customers? Are they going to come back? And you'll be surprised that often you're so in love with your idea. And I, as a former entrepreneur, made this mistake before, that you kind of forget that, and that's really always our core main advice.
And I guess I'll end on an up note that there's still a lot of private capital out there looking for driven, creative entrepreneurs. It might not be as easy as it was 12 months ago to develop relationships. So invest a lot of time in thinking about not just the right set of investors for this round, but the right set of investors for next round, and start to build those relationships. We're all open for business. We're looking for the best talent. And I think let's keep top of mind that the problems we're trying to solve in inclusive fintech have been magnified over the last 10 months. So we just need, we need more entrepreneurs thinking more innovative and creative solutions.
Great. Great. Let me turn to some of the questions we're getting from folks in the audience. This is from Insister Partners, and I'm going to put a little tweak on the question here. But under the new normal, where conferences have gone digital and travel is not feasible, how do the panelists identify and develop relationships with local funds? And I'll add with sourcing deals. Are they finding that they're falling back on established relationships for that?
Maybe I'll fill the silence. I mean, yeah. I think what has changed is a greater receptivity to partnering, right? The idea that I would reach out to somebody I've never talked to before who runs a local fund in a market that I haven't worked in, but say, hey, I'd love to figure out how we work together. I bring capital, and hopefully I bring smart, intelligent capital. But what I'm missing is your local presence. That openness has changed, right? And so I think there's a lot more receptivity on both sides to start thinking about the right syndicates to help these companies get to the next stage. And if I were to step back, and I'm an entrepreneur in this inclusive fintech space in a market, what I'm looking for is 2 or 3 skill sets. The local connections, as Tarek said, talking to the regulator, being able to open those doors, very, very important. Knowing where the highway is broken or there is no highway is so critical, right? The second thing is, to what Melissa said, maybe these patterns or these ideas have been tried before in another market. So who's bringing you that global perspective? And the third piece I'd say is often content, right? If you're building infrastructure, who is the best investor who's thought about deeply that subsector around infrastructure or payments or credit? So how do you put this together, right? There's a greater receptivity from investors to start thinking about architecting these partnerships and pairings and syndicates, because it's going to take all of those skill sets to help these companies become successful.
Yeah, I'll just jump on that. I think there's been also, I'd say, a higher level of transparency. I belong to a lot of groups with other investors, and they tended to be more around our own personal and professional development and just kind of getting to know, and I'll call you when I need you. It is, in a good way, it's become much more transactional. It has become much more, hey, have you heard of this company? And I don't know that we have any more time just because we're not traveling, but we're making things move faster. So I would also say that the speed at which people are connecting, the speed at which we're sharing information. We had an investor here that had never invested in Black and Brown founders before, so we turned over all of our portfolio data in complete trust because they needed to better understand, while we've approved this allocation of funding, I don't even know how to sell it to the investment committee. So I would say that there has been a reliance on existing relationships that probably have never been tested this way, but there's just a safety net that we're all in this together, so let's make it through. And I would say an element of expediency, not to the detriment of having integrity in the investment process, but being mindful that as an early stage investor, for some of these entrepreneurs, if we don't get to them soon, it's over. And being able to see the short-term need for probably more financing than normal. We've certainly increased our check sizes, but also recognizing this doubling up at the onset is going to have significant longitudinal impact if we can get it right. And the final thing I would say that I think we've heard from everybody is we're spending a lot more time with our entrepreneurs. We used to do kind of these quarterly calls that are very much one-off and how do you do, we've actually now kind of created this family reunion where we're bringing all the entrepreneurs together and saying, look, you guys are experiencing some of the same stuff. Let's just get it out on the table. Like, this is a no judgment zone. Like, don't worry about making things look good for me because I know they're not good. So I think this issue of transparency and really creating, ironically, a set of trust that probably didn't exist before, but that was because of a very hierarchical relationship. We're all sitting at home. We're all using Zoom. We've all got kids in the background running around making noise. We're all in this together. And I think hopefully that continues because that's been a really nice shift in this ecosystem.
Great. Another question, shifting gears from Extra Mile Africa. How could fintech founders use technology to deepen financial education and literacy, which is so low in many parts of the world and critical for actual adoption and usage of fintech? They give an example, credit access is still around 3.3% in Africa compared to other continents due to low financial literacy levels. So Maelis, especially curious, maybe to turn to you, sort of, is that something across your portfolio? How are you working with?
Yeah, it's a great question. And I will start by saying that there's been, I think, in our industry, a lot of pushback with financial education and financial literacy methods. And I think that overall, we haven't yet found really a correlation between a classroom style financial education, say, delivered to consumers and better usage or ultimately better financial wellness outcomes. So I have a great deal of skepticism coming in. But what we've done with a lot of our companies is see how you can actually integrate financial advice or financial coaching or financial education tips within the product itself. And so recently, for example, with a company that does offer the salary advances and is thinking also about integrating savings, etc., financial education was a big part of what they wanted to offer to customers, realizing that there was that gap. And so what we've done is looking at the overall customer journey and the product journey and thinking through what are certain concrete actions that we can incentivize that we know are linked with better financial outcomes and better financial behavior within the product itself at critical moment versus being its standalone module. So thinking about, okay, if I need to build a budget and I have my app where I can get my salary advance, but also build my budget, maybe you, when the user builds his profile, ask prompting question. When is your rent due? How much is your rent? When is your next utility bill? And like helping with very simple and easily understandable questions to then drill down to what that full budget might look like. And then there's other things that we borrow from behavioral economics, where you're thinking about, for example, showing your salary, and you know that it's X amount, say $100 in the month, but in the screen, you actually break it down in a weekly budget. So you don't show that you have 100, you show 100 divided by 4, and every week it gets updated. That actually has an effect into our psyche, our cognitive understanding of that, and you will likely spend your money slower, so your salary will last longer. So all of those things are much more product changes, and that's how I would think about it: lead outcomes via the product versus standalone modules. And also, stories, examples, video content, engage, really things that can lead engagement work better than sort of text-based. So it's really about the design as well of those financial education solutions.
That's great.
I'm very passionate about this, so I could go on forever, but I'll stop.
Yeah, behavior change is hard.
Yeah, very hard.
Great. Well, we are at time. So I want to thank all of the panelists for their great insights during this roundtable. And yeah, looking forward to see how 2021 goes. And I'm glad to hear the optimism that we all share for what it will bring for inclusive fintech. Thanks again.
Thank you.
Thank you.